Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with David Koenig and Ken O'Keefe from Russell. Gentlemen, thanks for being here, appreciate it.
Thanks a lot, Tom, great to be here.
So there's been a lot of attention on the flows that have been going into certain areas of the market. Maybe you can start, Ken, give us a little insight into where the money's been going, the smart money.
Sure, great question. And we're on track for another year of record flows. Last year through August, there was about $90 billion in flows. This year, we're already over $100 billion. What's interesting is this year, the flows are much more balanced. Financial advisors are really, if you will, making sure their clients' portfolios are properly balanced. So you're seeing pretty much even flows into fixed income, $29 billion, international equity, $37 billion, US equity, $34 billion. Last year, $78 billion into US equity, a lot of chasing of returns. So this year, much more balanced.
Balance between growth and value as well, or would you see an overweight in a certain area?
Great question. So within US equity, there is a growing usage of smart beta 1.0 as well as 2.0 types of products. 1.0 being value and growth, over $10 billion of flows there. The products like fundamental, equal weight, factors, dividends, seeing $16 billion in flows.
So speaking of those types of indexes, David, you guys have been very innovative in the way you're creating new and innovative indexes. Give us some insight.
We have. We've launched new indexes on many of the strategies that Ken just discussed, and we're spending a lot of time on educational efforts with clients around those smart beta strategies and how they can incorporate them in their portfolios. But we're also spending a lot of time talking about those traditional growth and value investments, which remain very important core portfolio allocations. So talking about how these traditional growth and value styles are similar to some of the more focused factor strategies, how they differ, but very importantly, how they can fit together within client portfolios.
And we've seen more, not only advisors, but institutions adopting smart beta strategies, right?
We absolutely have. In fact, at Russell, we conducted a survey with our institutional clients and published that earlier this year. And we're finding a very widespread and growing adoption of smart beta strategies by institutions. Particularly among the largest plans, but among plans larger than $1 billion in assets, about 75% have adopted some smart beta strategies, and very importantly, about 50% of them are planning to increase their allocations over time. And they're adopting these strategies for a number of reasons: for return enhancement, risk reduction, income purposes, and just diversification purposes as well.
And the great thing about this, again, especially with the growing tools of ETFs and that inherent discipline that smart beta provides. I mean, many big shops and even institutions have the ability to maybe do it themselves, but the fact that you folks actually do that for them at such a reasonable price, would you say that that's one of the big keys of the adoption, the flows that you're seeing, Ken?
Absolutely. It's a really democratizing way to bring institutional thought processes and investment strategies to, if you will, the retail world, financial advisors. And it's very interesting to see that, not only is there a good piece of research that we did on institutions, but there's similar research with financial advisors adopting smart beta, and they're adopting for the same exact reasons that David just laid out. And the adoption rates are not that high just yet. 25% have 10% or more of their portfolio in smart beta, meaning 75% have 10% or less. But 98% of financial advisors say, I'm going to invest as much or keep my investments in smart beta. So it's
very interesting, actually, just to follow quickly on Ken's point there around the adoption. In the institutional survey, what we found was that about 2/3 of institutions had 10% or less of their allocation to smart beta strategies, but on the other end, about 20% had greater than 20% allocation as well. So we're seeing institutions dipping their toe in, but once they do add these strategies to their portfolios, seeing them performing the way that they expect to and providing what they had expected the strategies to provide, they're increasing their allocations meaningfully. It's really that middle ground that is the smallest allocation.
You folks do great research. We write about it on ETF Trends. We also really enjoy going to your site because you have a lot of good research, white papers, that type of thing. Russell.com, is that right?
Russell.com, and we have an advisor-specific site that we launched with a great deal of educational materials as well, white papers written specifically for financial advisors.
And that site is?
At www.methodologymatters.com.
Methodology Matters, all right. Guys, thank you so much. Appreciate you being with me today.
Thank you, Tom.
Thanks so much, Tom.